members. Welcome to today's CPE meeting on internal financial controls by CAMP Vijay Kumar sir. May I now request the sir to occupy the dais. Before we proceed to the technical session, may I now request all of you to rise for ICA motto. Thank you, members. May I now request CA Venumuthu sir to formally introduce MPV sir.
Good evening, ladies and gentlemen. It's been a long time since I've been in a class. I was actually looking forward to hearing MP Vijay Kumar. I probably come from a time when I was a student here many decades ago, and I had teachers like Mr. Bhupati, etc. MPV was not a teacher here at that time, but I have been reading his blogs and I've been following his articles. And I find him to be one of the most interesting writers and professionals amongst us today. It's indeed a pleasure and a privilege to introduce him. Though I don't know him personally, I've been given a whole 2 sheets. I will read what is relevant, and I'm sure all of you know him well enough. You don't need an introduction, but formally, as a matter of protocol, let me say, of course, he's a fellow member of the Institute of Chartered Accountants of India, as well as a fellow member of the Cost and Management Accountants, and a company secretary as well. He is currently the Chief Financial Officer of Sifi Technologies Limited, an Indian information and communications technology company listed on the NASDAQ, with operations in India, North America, Europe, and Singapore. He's been recognized widely in various fora, and he's been recognized as among the 100 most influential Chief Financial Officers of India by Certified Institute of Management Accountants of London. In 2016, he was in the CFO role, of the Role of Honor by CFO India. 2017, he was given a National Award for Contribution in Financial Accounting by Capital Foundation Society, given by Honorable former President Dr. Pranab Mukherjee. He's of course currently a council member, and as a council member, he chairs the Evaluation Standards Board, the Digital Accounting and Assurance Board. He's also the Vice Chairman of the Accounting Standards Board, Financial Reporting Review Board, and the Committee of Accounting Standards for Local Bodies. He's a member of several committees of the Institute. He's also a nominee of the Quality Review Board by the MCA, and a member of SEBI Committee on Disclosures and Accounting. He's currently a Director of Sifi Singapore Private Limited and National Internet Exchange of India, and Tejo Engineering Limited as well. Active contributor to many associations and several memberships as well. Most famously, he is known as a resource person and as a teacher. He's authored several books, and I'm sure we are in for an interesting 2.5 hour or 3 hour discussion on internal financial controls. Have a good evening, ladies and gentlemen. Thank you.
Thank you for that introduction and kind words. Senior members of the profession, professional colleagues, very good evening to all of you. So what I do is, this is a subject which has been there for now almost close to 5 years, and particularly last 3 years, lots of discussion and practical experience has been gained on this topic. And this is a topic of very high relevance to both members in the industry as well as the practicing chartered accountants, including those who are internal auditors, may not be certifying as statutory auditors or expressing opinion as statutory auditors, but still as internal auditors also the topic is extremely relevant. What I do is, given the fact that typically you have a mixed audience, I'll still spend about 45 minutes or an hour in introducing what this subject is all about, then probably share some practical nuances, probably total engage you for about 2 hours, and then leave about half an hour or so for informal discussion on the various issues concerning IFC implementation, and where you could also share your experiences and we could interact. Before I could start formally talking on this topic, let me set the context. I'm not sure how many of you have this experience of having received notices from ROC. In fact, over the last year in particular, the office of MCA or ROC has been in a fairly hyperactive mode, and at least a good number of companies where where people have interacted with me, or chartered accountants who are auditors of those companies have interacted with me, have shared their experiences of the kinds of notices they have received. I'll just give you one very recent example. This is a call I had little less than a week back, and this is from an auditor of a listed company which is a fairly large size, just below 1,000 crores, a net profit just about below 100 crores, and this particular company has been in existence for 30-40 years, a fairly well-governed company, good set of directors, etc. When the MCA had actually gone for an inspection, among the various documents they saw was the internal audit report. And in the internal audit report, it was a manufacturing company, was a supplier essentially to OEMs. So there was some residual receivable of 1,25,000. Look at the numbers which it told. A residual receivable of 1,25,000 not collected for some time, which the internal auditor had in his report pointed out that the amount needs to be written off. Whereas the audit committee, for whatever reason, they felt it was not required to write off. So notice goes to the statutory auditor. How did you give a clean opinion on the IFC? How did you give a clean opinion on IFC when this amount was not written off? So he tried his best to explain, look, A, amount is not material. B, the fact that it got detected, the fact that there was a receivable which could not be collected, the fact that it was evaluated by management, brought to audit committee, were all evidence of the functioning of controls and evaluation of the receivable, and it was a decision not to write off. So where is the question of I as an auditor making a disclosure of that or qualifying an IFC? Nothing doing, but he decided to issue a notice and also serve a penalty notice. So this is the ecosystem. I'm not sure how many of you are experiencing something similar, but the number of such cases are increasing. So at MCA, it's important that they should regulate. I'm not saying that they should not regulate, it's important. Having not regulated for a very long time, probably suddenly regulating looks a little odd. Probably that's a new level which probably all of us need to get familiarized with. But this kind of regulation without an improper understanding is also a pain which we need to go through in the process. The second point I'd like to share as part of the context setting. Over the last few months, all of you have at least come to hear of probably a NFRA getting constituted and rules to get notified. So that's still work in progress. And at the institute, there's a lot of representation and fight still going on to help the government to understand that 132 is not relevant in our country for ABC reasons. Probably at the end of the session, depending on your interest, we can spend some time on that. I believe all members should have a good understanding of what's happening on the Section 132 notification, and including those who are in industry. In fact, I've come across many who have this impression that NFRA is meant only for those who are in practice. I'm sorry. NFRA will first cut the throat of those who are industry, then only comes the auditors. So NFRA is all about regulating compliance with the accounting standards and thereby the auditing standards. So responsibility of complying with accounting standards lies first with the preparer, that's the industry, and draft rules are specific provisions holding the industry responsible. So if somebody thought NFRA is only for poor souls who are in practice and the industry members are not so very concerned, that's a very wrong understanding which is existing, but it is equally harmful and damaging with one more authority inside the Companies Act on NFRA. Similarly, we have Reserve Bank of India having showed its intent to do a little bit of regulation. Same is the case with SEBI as well, who has also expressed interest to regulate the accounting, basically the audit functioning. Despite the fact that all these guys had established institutional mechanisms to do an oversight, all of those mechanisms have never been allowed to function, and suddenly now everybody seems to be getting up. For example, in the context of SEBI, there is a body inside SEBI called QARC, Quality Audit Review Committee. That's a body which was set up inside SEBI, and it's been there for more than a decade within SEBI. And this body is supposed to review all the audit opinions, particularly the modified audit opinions, and wherever the opinions, they find it that they are not being done properly, they refer it to the institute. Institute at FRRB does a complete review and gets back to QARC, and a disciplinary process starts off. But QARC has been dormant for almost 7-8 years. 7-8 years, nothing has been happening there. So many of these existing institutions, their own structures have not been active, but suddenly they're all showing these tendencies of trying to innovate from the existing ones, introduce some structures for oversight regulation. The point I'm highlighting in terms of context setting is, it's no longer as in the past. You have almost every regulator trying to now be a little more active in terms of regulating the entire corporate functioning, whatever comes within their domain, be it the MCA through NFRA for a select category of companies, including listed companies and some unlisted companies. They have defined some thresholds. These are not in public domain officially, but some of you might have got it unofficially, and I cannot share you those numbers, but the intent is to govern listed companies and some category of unlisted companies. SEBI obviously only listed companies. RBI, those who are auditors of the banking system. So all of them are trying to develop their own structures of how to regulate the entire financial reporting mechanism. Now, having said all this, essentially to set the context, I will now introduce what the IFC is all about. And on IFC, what I found is many accountants, whether they are industry or in practice, leave aside the large companies who have invested, that's the right expression, in the function for risk management and ensuring controls. Most organizations, it is essentially a checkbox. So it's essentially a checkbox. So where you have within the organization something to say it is existing, and you have a audit support mechanism who also has been sort of enabling that to continue. But I think it's high time that we shouldn't allow any of those to continue. I've always held the view that as far as auditors are concerned, not being assertive when you are empowered is a big failure. So as far as auditors are concerned, we have been empowered to comment on the existence of internal controls and the operating effectiveness of the same. Compromising on that particular reporting is a fairly serious failure. So many I come across see it as a checkbox item. Probably it will change, at least after all these developments of the recent past. As far as IFC goes, from a pure technical definition. Some of these I'll read it verbatim to ensure that we focus on some of the keywords. Otherwise, it tends to, as I mentioned, just a checkbox item before somebody issues an audit opinion. The entire internal financial controls has 5 key components. One objective, whatever policies and procedures an organization lays out. I'll leave a copy of the slide deck behind. No need to write the contents of the slide deck. I would encourage you to write issues which you would like to discuss, your practical issues which you would like to discuss. We'll have at least 30 minutes to discuss. So 5 key components of all the policies and procedures which an organization defines, which should meet these 5, any or all of these 5. 1, an orderly and efficient conduct of its business, including adherence to the company's policies. So first, it should enable a very orderly conduct of its business, and it needs to be efficient also. Look at those words. Each word is very efficient. Very, very important word. So when you are expressing an opinion, more particularly as an internal auditor, supporting an organization to improve on IFC. As a statutory auditor, I have responsibility to give an opinion, issue it as part of my main opinion as an attachment. But as an internal auditor in particular, when I examine the policies and procedures of an organization, is it helping a very orderly conduct of the business, and is it helping the business to be efficient? That's goal number 1. Second goal is safeguard its assets. So when it comes to safeguard its assets include not just the assets for which people are very comfortable in terms of physical verification. So not just fixed assets, not just inventory. It includes every other asset appearing in books and not appearing in books. Appearing in books and not appearing in books. For example, receivables, lots of advances, lots of EMD deposits which are given, rental deposits given, all this based on size of the entity. All of these. So the mechanism to safeguard the assets of an organization beyond the fixed assets which normally hit our mind and we spend a good amount of time creating working papers, or the inventory. Its scope goes beyond that and includes receivables, advances, and every other item in the balance sheet, and not in the balance sheet as well. I'll spend a minute on that. Items not in balance sheet, essentially 2 things. 1, there are assets which could have been fully written off, but they're still in use. That's one category of assets. The second category of assets which are not in books, but they contribute significantly for an organization's value and shareholder wealth creation, are the intangible assets. Look at every organization which is 5 years old, 10 years old, 15 years old. You have a book value of the business, assets minus liabilities, book value of business, let's say for discussion's sake 100 crores. All of us know if there is a 15-year-old business with net assets of 100 crores and fairly doing well, its value is not less than 250 crores or 300 crores as a thumb rule. 2 times book value, 3 times book value, some number. Now, as an acquirer, if I were to acquire the business, I would have paid 300 crores for exactly that 100 crores of net assets. The difference 200 would get identified as various intangible assets. Now, these intangible assets don't get created all of a sudden when the organization gets transferred or bought. Those are intangible assets which are there within the organization, but they have not been accounted inside the books. For example, brand building expenses. So as an organization, I would spend 30-40 crores for building a brand. Accounting requirements, because it does not fulfill the requirement of control over the resource. It does not fulfill the definition of intangible in AS 26. The 40 crores which you have spent over whatever time, you have recognized it as an expense. But in substance, it is an asset. So for accounting purpose, you would have treated it as an expense, but it is an asset, and that asset actually belongs to the shareholders or the stakeholders. So that particular asset has a value. So when it talks about safeguarding the assets, assets include not just these 2 tangible assets, fixed assets and inventory. It includes every other asset, including receivables, advances, and everything, plus those which are not in books, the couple of examples which I gave you. That's the second objective. So the policies and procedures which you design and implement should help you to safeguard all of these assets, the discussion which we just went through. The third element of the definition is prevention and detection of frauds as well as errors. So these policies and procedures, how good they are in terms of both preventing the same and if it happens, the ability to detect the same. So how good they are for prevention as well as for detection. So they should have this as one of the objectives to be met. The fourth objective is accuracy and completeness of accounting records. And if you look at the accuracy of completeness of accounting records, just look at this is a very closed forum, so permit me the liberty of speaking freely. I've been in practice myself for 9 years and I've handled good number of statutory auditors where thanks to God I've signed and escaped. At least the 7-year period of the institute is over now. But otherwise, if I look at all those statutory audits, at least my experience, at the year end, the number of accounting entries which you have passed, not recorded earlier, which you record now, recorded earlier wrongly, which you rectify now, humongous number of entries. So the fact that you have so many accounting entries which you record while doing the process of preparing financial statements or while doing the audit is itself a good evidence of the lack of internal financial controls. So internal financial controls requirement is that you should have good accounting records, and these accounting records should be both accurate as well as complete. And this is not accurate and complete as at the end of the financial period. So if you look at all of these are not requirements as at the end of financial period. These are things which should actually exist throughout the year. Most of the controls you are required to design in such a way that they can be tested throughout the year. So unlike in Caro, for example, in Caro we have a very good freedom. In Caro, let's say for example the fixed asset register is not updated. During the year it's not updated. In Caro, you have the flexibility where even after the year end, you can update your fixed asset register and the auditor can be satisfied about it and you need not pass any negative observation. So the institute guidance note and Caro itself allows that freedom where if in the context of Caro, it's more or less like at the time of reporting, have all of these things been taken care of. So that kind of freedom is available in Caro, whereas the same does not exist in the context of IFC, which is a requirement which has to exist right throughout the year. And when you design, you need to design in such a way that good number of controls can be tested throughout the year. And lastly, a timely preparation of reliable financial information. So when you talk about timely preparation, so as far as the timely preparation, almost at least my experience, let me quote my experience and I can quote it shamelessly and boldly too. So most of the audits, including for the unlisted companies, private limited companies, invariably would get done close to end of September. And you know how those AGM dates are all recorded, all this kind of stuff. Now, with all of that stuff and your mailbox being full of evidence of information flowing, September 12th, September 17th, September 18th, draft financial statement, modified, all that stuff, to say that the board meeting is approved on August 23rd, 21 plus whatever days notice, all of that stuff. So those are all control weaknesses which exist. So all these, more often than not, innocently all of these evidences are left. So the IFC requirement is that not just the first four, you also need to have a mechanism where the financial information can be prepared in a timely manner. So these are 5 important objectives which a good IFC framework should achieve through having the right kind of policies and procedures. So that's the first requirement. So as far as these 5 requirements are concerned, responsibilities have been placed across 3 stakeholders. More often than not, many of us, particularly in practice, have a tendency of assuming all the 3 levels, responsibility for all the 3 levels. So designing the controls, implementing the controls, testing the controls, and forming an opinion. So all of those things are assumed by the auditor while giving his opinion. So whereas the IFC requirement is a very clear 3-tier architecture. So one is with reference to the responsibility of management, responsibility of the board of directors, but more specifically the independent directors, audit committee for companies where there's a requirement of an audit committee, and then comes the auditor. Auditor responsibility is the last. Auditor's responsibility is the last. So every conversation with the management, it's extremely important to tell them that, look, this is your responsibility. It's not my responsibility. My responsibility is very simple. I will just give a modified opinion, be it a qualified or an adverse or a disclaimer, and with that I am done. But the moment I give a modified opinion, it would get triggered within the MCS system, and it would be followed up with a query process, an inspection process, depending on the sample and all the kind of stuff which is there. So as far as the management is concerned, it is their responsibility to ensure that these controls which exist are enabling an orderly and efficient conduct of the business. It is their responsibility to ensure that there is an effective risk management mechanism existing within the organization, and it is also their responsibility to ensure that all the compliance requirements are taken care of. When it comes to the independent directors and the audit committee, in the case of companies wherever the audit committee requirement exists, they need to oversee the efforts of the management as to whether the internal controls which are existing within the organization are adequate enough or not. Are they adequate enough or not? They need to satisfy themselves. And more importantly, they also need to get a judgment on whether there is adequate efforts being put in for continuously evaluating the effectiveness of the management. Look at most of the mishaps happening in the corporate sector, including the banks, which we are all aware in the recent past. Now, if you look at all of those failures, the failures have happened at the management level, they have happened at the directors level, then comes the auditors. So, as far as auditors are concerned, while they are the last line, what is important is, as an auditor, you always have the opportunity to see whether management has done this, whether audit committee or independent directors have come this, and then you can comment on it. So if those two are not there, your job is fairly simple in terms of making an opinion or coming to an opinion on the existence of the controls or effectiveness of the controls. But more often than not, there is a lesser time which is invested on these things. Just look at within these four walls, and I would like to look at it very objectively. Let's look at the incident of the banking system itself. While I do agree that, and I will continue to support that cause for time to come, the fact that whatever has happened in that particular bank was not in the books and all that stuff, I'll continue to support that kind of a view which has been taken, because there are limitations in the overall audit part. But just step back and look at it very objectively. So if you step back and look at it objectively, as a management, that layer 1, was it possible to have a view of those transactions which are happening and put in place adequate controls? Was it possible for the management? The answer obviously is yes. You cannot have a second answer on that. And as directors and as audit committee members, if they had spent enough amount of time to understand the control systems existing within the organization and whether the management has taken enough efforts to evaluate the effectiveness of the same, then probably that could have also been discovered. So that's again an evidence that it has failed there. Then comes the auditors part. And as auditors, you also had a similar opportunity of testing on those things. So this IFC, from a tool perspective, I call it as a very sophisticated tool for conducting the business very efficiently. I always equate IFC as good safety systems in a very high-powered automobile. So in a good automobile, if you have good safety systems, your ability to drive fast is high. So IFC is equal to that kind of safety systems. So if those safety systems have been designed, and if the brakes, if the seat belt and all this kind of stuff were functioning effectively, these kind of accidents would not happen. Even if the accident happens, the damage would be minimal. And many of these systems, many of these safety systems today, if you look at those sophisticated cars, once the brake is not functioning properly, there's an alarm in the dashboard saying your brake is weak, or seat belt you have not yet worn. So there are all those alarms. So the IFC is supposed to be designed in such a way that those alarms are supposed to come, so that if there's a prevention mechanism, there's a detection mechanism. Had those been effective, then probably all this damage could have been avoided. Just look at the kind of impact on the public money and also impact on the economy in terms of slowing down the negative pessimism in the minds of all the regulators and all the managements of the various banks. Because of one incident, everybody becomes pessimist and consequently the economy growth itself suffers. So that's on the 5 components. Now when it comes to internal controls over financial reporting, internal controls over financial reporting is a component of IFC. There's a component of IFC, and in international context, the board signing off and the auditor signing off is essentially on the internal controls on the financial reporting. It has a very popular jargon like ICOFR. So on financial reporting, the controls are required to ensure 4 things. The internal control financial reporting, 4 things. 1, you need to get a reasonable assurance. I want to spend a minute on the word reasonable assurance and not an absolute assurance. So the control should be such that you need to just get a reasonable assurance. There is no expectation of an absolute assurance. Whereas if you generally look at the external stakeholders, particularly the government, there are many occasions they have a thinking that once an auditor has signed, it's like a mother promise. In fact, people many times make a kind of an observation that next to the President of India, our signature is the most valuable and all that kind of stuff. And by making those observations, you are taking upon more responsibilities than what you are actually capable of taking. More responsibility than what you are actually capable of taking. So this ICOFR here and the overall audit standards, they have always expected only a reasonable assurance. An absolute assurance is expected only in the context of certificates. But when it comes to an audit opinion or in the context of even internal controls and financial reporting, what's important is only this reasonable assurance. And my 2 cents of inputs here is, every time you present to the audit committee, I'm sure many of you are practicing auditors, either as internal auditors or stat auditors, I would recommend, even though it might look a very routine kind of a thing, I can share from my experience of interacted with auditors in India, a little outside of India, do not hesitate to spend about 2-3 minutes for what I call as this mandatory slides. They're a little boring. So when you go to a movie, you get that smoking is injurious. They're all a little boring, but they're all mandatory things which have to be gone through. Similarly, when you present it to the audit committee, it's important that you highlight at the start itself that my job warrants only a reasonable assurance. Keep repeating it so that all these stakeholders present there get it very hard in their mind that these guys are only giving me so much. So if I want more than this, then I need to go and do something else. So they are telling that I am giving a reasonable assurance, and these are areas where they are expressing as judgment areas, estimation areas, discussion with management, they have shared with this. So it is for the board of directors and audit committee to pick a thread from that and say that receivables looks like something is an issue. a revenue recognition, something is an issue. Let me go and get it investigated. That is their responsibility. It is not my responsibility. So it's important that right at the start of the audit committee presentation or board of directors, make it a point to go through that mandatory slide of reading and reiterating that what I am giving is only a reasonable assurance, and that's what my audit standards framework requires, and that's what ICOFR also requires, and I stop with that reasonable assurance. So that's the first expectation. A reasonable assurance regarding the reliability of the financial reporting and the preparation of financial statements for external purposes in accordance with the GAAP which is applicable. Second is on the maintenance of records. Third is reasonable assurance that transactions are recorded as necessary and with due authorizations, so they've gone through a due process. And lastly, assurance regarding the company's assets. So if you look at it, this will there's a subset of the first slide which I took you through, where you had those 5 components.
Sir, can you explain the first line with an example, sir?
A reasonable assurance regarding reliability of finance. So as far as the financial statements are concerned, all of us are aware that it's plenty of estimates and judgments. And the entire process which we have, any of us follow, to come to an opinion on existence of controls, effective functioning of controls, is all based on samples, etc., which have been done. So what you are highlighting as part of the first bullet point is that, look, I have performed my work procedures according to the guidance note given by the institute, the audit standards which are available, SA 315 and all, I have done the job. Based on that, I am giving a reasonable assurance that the financial report which is done, the balance sheet, whatever, all of that stuff which is done as per GAAP, there is, you can rely upon it. Because if you look at financial statements, it's invariably made up of lots of judgments and estimates, right from life of the asset, NRV for the inventory, provisioning for receivables, provisioning for various other elements like tax, all of that. There's so much of judgments which are involved. So you're basically giving them the reasonable assurance regarding to what extent you can rely on the same. So that's the point number 1. So internal controls or financial reporting. So as we just talked about, it's a sum of the components which we just discussed. Maintenance of financial records in reasonable detail, accurately, and it should fairly represent the transactions which are taking place. Authorization of transactions, very important. So what enters the books should go through a due authorization process. You should never have a situation where something enters the books without having gone through a due authorization process. In fact, if you look at the same banking example which you have gone through, you had all those inflows and outflows which have happened. So same day they had about 100 crores coming in, same day 100 crores going out. So net effect on the closing balance is nil, but money has come in and money has gone out through those Nostro account. So anything which is recorded, has it gone through a due authorization process? That's an important element of an ICOFR process, and safeguarding the assets in such a manner that you can prevent, first of all, any fraud risk. And if at all it happens, it will happen. At least my experience, frauds will happen as the organizations become large and geographically they're spread out. Frauds will happen. If somebody says that frauds will not happen, I don't think, at least I will not believe. As organizations grow and geographically they grow, particularly high growth organizations, they will have some elements of frauds. So ability to detect those unauthorized transactions which enter the books, unauthorized usage of any assets and things like that. As far as fraud risk is concerned, all of us are also aware about the fraud reporting responsibilities which are there in the Act, which are fairly onerous responsibilities. And on fraud, many occasions I have come across a tendency where the moment there's a fraud, the tendency is to see how we can manage it without the need for a reporting. But there's nothing wrong about it. In fact, one good thing, at least after I came back to industry, the experience I have gained is it's always easier and safer to report it, because once you report it, it's off your hands. It's gone. So every organization, there is bound to be some amount of frauds will happen. So those cases with frauds happen, the safest thing and the best thing to do is disclose the fraud that the fraud has happened. There's nothing wrong which is there by reporting a fraud which has happened. Whatever be the fraud, there's nothing wrong about it, and no point in trying to find a solution of how can we mitigate the fraud, can we bring it to a definition less than a fraud. You don't achieve any purpose, and somebody need not be defensive that a fraud has happened, something has gone wrong. For example, all of us, I'm sure, can cross the road well. All of this we can do, but if I were to cross the road 1,000 times this Nungamakam road, I'm sure one time I'm bound to trip. One time there's a possibility somebody might come and hit me, at least rear view mirror will hit my hand and go, or he might knock me out. That's a possibility which does exist. That 1 out of 1,000 can be the 10th time, it can be the 80th time, it can be 720th time, but the possibility does exist. So for every organization, if there is a fraud which is there, the best is to report the happening of the fraud, and none need to be ever defensive about a fraud having taken place. Fraud can be with reference to a revenue which has been inflated and reported. Fraud can be with reference to collections which have been done and not accounted. There's so many frauds which happen. Any of those frauds happen, the best thing is to do is to report the existence of the fraud and to give a comment that steps have been taken for the prevention of similar things in the future, and that would suffice. So all these three together constitute the internal controls or financial reporting. Coming to internal financial controls, so that's the bigger part. When it comes to IFC, on IFC essentially there are three main components. The policies and procedures are designed to achieve those 5 goals. To achieve those 5 goals, there are 3 main components. One is internal controls or financial reporting, what we have just gone through. Second is operational controls, and third is fraud prevention. So as far as the operational controls are concerned, operational controls include controls like segregation of duties, controls like compliance with the delegation of authorities, whether the right kind of people have right approval of authorities have signed or not. So all of those would constitute your operating controls. And third, with reference to fraud prevention and detection, that's again a conversation which I just went through. So a summation of all the 3 together would constitute your internal financial controls. So the key difference between ICOFR and IFC would essentially be the existence and the evaluation and testing of the operating controls. Now, under the Act, who are the people who are responsible for the IFC, the design, ensuring its existence, evaluating its effective functioning, and testing the same. So for this, responsibilities are cast across multiple people. So some responsibilities at the board level, some responsibilities at the directors or audit committee level, some responsibilities at the auditors level. So as far as the director's responsibility statement is concerned, this responsibility statement has a very specific requirement. One, in the context of listed companies, the existence of IFC, which includes operating controls, and the fact that these controls are adequate and they are operating effectively. So when it comes to the other than listed companies, the focus is essentially on the internal financial controls with reference to the financial statement, basically our ICOFR requirements. For independent directors, we have the code that is Schedule 4, and in Schedule 4, independent directors are being given the responsibility where, and imagine independent directors come from backgrounds, nothing to do with finance, backgrounds, nothing to do with the corporate law, and many occasions they are pure technical guys, engineering guys and things like that. And for them, sometimes I'm surprised they accept the responsibility of becoming a director. In fact, everybody accepting responsible director, at least I feel nervous. At least if he is known to me, I feel a little nervous that poor guy, he has gone and taken that responsibility. So as far as the independent directors are concerned, they are required to satisfy themselves on, look at the words, integrity of the financial information. So tomorrow if you have to hold a person responsible, so you can tell integrity of financial information, how have you satisfied yourself on the integrity of all the financial information which you have used it. and that the financial controls and the systems of risk management are robust and defensible. And that's a huge responsibility. While all the independent directors satisfy themselves using auditors, the external auditors, internal auditors, and maybe within the organization, some management team focusing on risk part. Well, all of that is done. The buck stops here at the independent directors level. So even if an external internal auditor comes and reports to me some 20 slides, my ability to understand all those 20 slides in the context of the integrity of the financial information which is within the organization placed before the board and the financial reports which are there. So that integrity the person needs to satisfy himself. So that's the requirement, and he also needs to satisfy himself that the control systems which are robust, they're not small words, they're very, very powerful words. You don't use the word robust just like that. So they're very robust ones and defensible ones. Audit committee, which is applicable only for a class of companies 10 crore paid up capital and borrowed funds and then turnover. You have those minimum requirements where audit committee has to be there. If there is an audit committee, among the responsibilities, audit committee has a responsibility of evaluating the internal financial controls and the risk management systems which are there in the organization. And they may also call for comments from the auditors and internal auditors about the existence of systems and all of that stuff. That's the responsibility of the whole of the audit committee. Auditors report, as far as auditors report is concerned, report requirement on the adequacy of internal financial control system in place, the operating effectiveness of those. So you have this several sets of people who have been cast responsibility under the Act for ensuring that controls are in place. And if after all of this which has been envisaged in the Companies Act and assume they've all existed for the last 5 years, and in 6th year still something goes wrong, then we need to see what else can somebody do beyond all these things which have been cast. So just a summary of the reporting obligations. For listed companies, unlisted public companies, unlisted public companies where there is a mandate for an audit company, that 10 crore, 100 crores and all, and last is private limited companies. For these 4 categories of companies which are there, what are the kind of reporting responsibilities or the management responsibilities which are there? Director's responsibility statement is a requirement only in the context of listed companies. For other entities, that requirement doesn't exist. Board report, it needs to be covered for all of the companies. Board report as part of the director's report, it needs to be covered. Code for independent directors, applicable only for listed companies. Audit committee is required, their requirement of complying. The provisions which we just discussed is for listed companies and unlisted companies where there is a requirement of an audit committee, which is the first and the third category. And auditor's report, it's a requirement for all the 4 categories of companies. So ICO for applicability, as far as this applicability is concerned, we just discussed the category of applicability. The exemption part of it. So it's not applicable to 1-person company, it's not applicable to a small company, and for companies with turnover of 50 crores or less than 50 crores as per the last audited financial statements, or borrowings of less than 25 crores at any point of time during the year. So for those organizations, not applicable. But the key point is, if these organizations have defaulted in filing the annual return or in filing the financial statements, then the entire provisions would apply. So non-filing of these triggers the provisions of the internal financial controls, and it is irreversible. So once it becomes applicable, not that subsequently I file and I'm out of it. So once you missed it and IFC becomes applicable, it will continue forever. So when it comes to listed companies, the applicability, this is the scope listed down in the clause 49 of the listing agreement for the board of directors and audit committee. I'll skip this part of the discussion, except that I'll focus on one element of CEO CFO certification, which is the requirement specifically there as part of the clause 49, where the 2 top executives are required to sign off saying that they are accepting responsibility, both CEO and CFO are accepting responsibility for establishing and maintaining the controls of financial reporting, and this is a reporting requirement which is there across the world. Across the world for all listed companies, you have a similar requirement, and these two guys are also required to give that certificate. And please note, this is not opinion, these are all certificates. So which means certificate would mean a mother promise. So opinion is a reasonable assurance, whereas when it comes to certificate, it becomes absolute assurance. Of course, this is not an audit certificate, so you can't use that terminology per se, but it's as good as the moment you say certificate, it's as good as I am saying that everything is existing. That I have evaluated the effectiveness of internal control systems pertaining to financial reporting, and the fact that I have disclosed to the auditors and I have disclosed to the audit committee whatever deficiency which exists in the design or operation of the internal controls, if any, which I am aware of, and whatever steps I have taken in the process. And my experience is on the last two parts, there is nothing harm. For example, in my organization, there are multiple, of course now I am not active, but when I was active, there are multiple lines of business. Some of them are relatively small, they are growing, they'll take time to get a size. So those cases, probably you yourself are finding out what is the best way of delivery of the service. You are still figuring out as to what would be the right kind of clauses you should have in the customer PO so that your interests are protected. So you're still figuring it out. It's all nascent. It's just 20, 30, 40 crores business. It's just growing. So those cases, there's nothing harm to tell the audit committee and the auditors that, look, this is just a business which is growing. We are figuring it out and we'll fix it over a period of time. So instead of blindly signing off saying that everything is all right, there's nothing wrong in saying that I have this 5-6 lines of services which are there. One line of service, this is where it stands. You take on notice. I'm keeping you posted of the same. And there's nothing harm about that particular observation. Let's take the case of last year, the GST transition itself which has happened. So all of us right through that particular year, lots of learning has been there. So instead of saying that I have done everything which is possible, there would definitely be many cases where probably some of the input credits are missed out, there's lack of understanding, system design, the IT system did not pick up all of the credits which I could have taken. There could be so many things. So those cases, instead of blindly signing that I have done all these things, look, tell the directors that there's a new legislation. I have done my best in appointing a consultant specifically to advise the company on the GST. I also got an audit done of the GST systems, and based on that, I am saying this, but it's a law which is evolving. Even as of 2 months back, as an example, 2 months back, we discovered that there are some credits which we missed out in the transition process. There are some customers who are refused to accept invoices which have given in the past. Whatever it is, just keep the board informed, and there's nothing harm about it. It actually reduces the responsibility of the people who are signing off. I don't think any of us should expect that I have 100% accuracy on everything which exists. It's like almost going to an exam. I don't think anybody can say that I have prepared 100%, I have studied all the 100 marks, I have scored well, I have written all the 100 marks. It's just not possible. So similarly here also, there is 80-90% of preparation which is there, 5, 10, 15%, there is that gap. So even when I write, I have written best of my knowledge, but I think 1 or 2 answers are likely to be wrong. So that is a typical answer. I don't think anyone should shy away from making that kind of observation, be it to the auditors or to the audit committee. I'm sure they will also have the maturity of understanding the same. So third and fourth are very important. At least these exist in the context of reporting for US listed companies for a long time. And now it's of course there as part of our listing agreement too. So annual report in the MD&A also have a discussion of the internal controls systems and their adequacy. The point I'm highlighting is, look at all the listed companies. So much is there within the Companies Act, so much is there within the clause 49, and despite all of this, if something is going wrong, it's all to do with the implementation of this. If implementation of all of this were to actually happen, I don't think the scale of misgovernance which you commonly hear about, or the kind of frauds which happen, would definitely not be happening. Now the approach towards IFC. So many risks for an organization, identification of all those risks. There are many risks beyond the general risks which are there for organizations like economic risk, the macro level risk, the political risk, and environmental risks. Those are risks which are existing. So beyond those risks which exist for an organization, different risks, and these are all risks identified in the institute guidance note. And guidance note lists down some of these important risks like regulatory risk, reputation risk to the organization, financial risk to the organization, people and property risk, legal risk, technology risk. So there are several risks. Some of those common categories of risk are these risks. So when you prepare your risk register and you design your controls, so those cases, typically it should have a risk register regarding each of these categories of risks which are there for an organization. And to address these risks which are there for an organization, what's extremely important in IT organizations language, we call them as PPT, people, process and tools. People, process and tools are key to address all of this risk. So on one side you have the risk structure at the high level, then you have the management level, and then the monitoring level on an ongoing basis. It's more like a dashboard, At the high level, you have the policies which you prescribe for an organization. You have governance structure which you have set out for the organization. You have defined functions for an organization, and you've got the right kind of people for an organization. That's the starting point. So as far as the structure of a risk is concerned. From risk management point of view, people, process and technology or tools, people, process and technology tools, at the entity level, at the division level, at the function level or SBU level, operational unit level. So how do you define all these risks and manage it at each of these levels? There are some risks which exist at an entity level, at the highest level. Some of it exists at the bottom, at a function level. Let's say a commercial function, an administrative function, what are functions? At a function level they exist. So you need to have a mechanism of listing down all the risks across, right from entity, right up to the function level, and have the right kind of people, right kind of process and the technology or tools for evaluating the risk there. And then monitoring. So risk assessment to be done on a continuous basis, and risk assessment including potential risk of frauds, and control evaluation to be done on a continuous basis, both financial controls and IT general controls, IT controls, and lastly on the support which is required in the control assessment. On the IT controls, let me spend a minute again in the context of the recent banking incident. If you look at that particular incident and many of the large audits I come across, most of the audit teams do not have within the audit team somebody who has a deep domain knowledge of the IT functioning. Today, it's completely IT. Every organization is completely IT. Beyond the point for an auditor not exposed enough on IT, there is excessive reliance on the output, and from the output, you just focus on preparing the financial statements and moving on. Particularly from a statutory audit point of view, let's assume that bank, I'm not naming the bank, I'm sure all of you can connect. So that particular bank, let's assume an IT guy was part of that particular audit team. All that he had to do is just take an Excel dump of that entire inflows and outflows of the Nostro account, and once he were to do some analytics on that, which for him would be hardly a half an hour or a 1 hour work. So once he knows the dump and is able to do some analytics on it, it would automatically throw up some curious questions to him. And for a guy who has expertise in that area and who has the habit of looking at data differently, he would start throwing open some questions to the audit partner, audit manager, who can then pick up the thread and move on from there. So for all the audit functions which you do, it's extremely important that we have people as part of the audit team who have a good competence on the IT element. It's not that we are not familiar about the audit. All of us are familiar about IT. I have familiarity about IT, I have familiarity about tax, I have familiarity about FEMA, I have familiarity about company law, I have familiarity about everything. But let's assume there is a case of some inward remittance of capital. I know FEMA, but the tendency is, let me check with a FEMA practicing consultant, this remittance is coming towards capital, so can it be accepted or not? Is there a particular circular which has come? What is the form to be filed? Who has? That's a very commonsensical thing, would be to check with the subject matter expert. I know FEMA, I know the circulars, master circular, all of that stuff I know. But still, it's not my day-to-day activity. So common tendency is to have that kind of check saying that there is a guy who is a subject matter expert, let me just check with him before I move ahead with the transaction. Same with GST. I also know GST, but so it becomes so specialized now. I still want to know, this is a specific transaction, I would like to get a view before I proceed forward. The same is applicable in the context of IT also. I've come across many auditors having this, please don't get me wrong, permit me freedom of expressing myself. So my experience is many auditors have this tendency that I know information technology, I know computer and all that stuff, but I knowing is different from somebody who has a subject matter expertise on how that entire technology works, whether the entire, it's a ERP or the process of extracting reports, how those reports are used for decision making, all that is a very specialized domain, and you require people having that kind of an experience to give you the comfort that yes, you can rely on these controls. And if you look at almost all organizations, today controls are largely IT controls. Manual controls are shrinking by the day. Manual controls exist and probably will continue to exist. Some cases there will be compensating controls as well, they will exist. But at least 80% of the controls in organizations are all IT controls. So that IT controls, for somebody to understand, an IT domain does make a difference, and it is good to make an invest on a resource who has good knowledge of information technology, make him part of the audit team while performing the audit. So that's one of the requirements of a control evaluation, both operational, which include IT general controls as well. And risk reporting at different levels, right up to the board of directors, senior management, middle management, investors, statutory auditors and regulators to recall fraud reporting requirements, where you have to go and report right up to the MCA. And just want to share with you, as far as NFRA and others are concerned, sometimes when you feel very low, you start laughing, it's something like that. They have gone to such an extent of asking the auditors to report directly to NFRA on all the control weaknesses which you have listed down. So at least today it's a fraud reporting alone which you report to the government. Just imagine NFRA comes as visualized by these guys at this point of time. Their expectation is, as the audit work is done, you don't even wait till it is finished. As the work is being done, you come across any control weaknesses, they'll open up a portal or whatever, and on that you have to keep on reporting that these exist. Look at the risk to the auditee, the people working there, and as far as the auditor, the ability to understand those control weaknesses which are there and the timely reporting of the same. So they've gone to that kind of visualization. Hopefully they will all not happen, but that's the intent which they have already expressed. Hopefully it should not happen. Now, on operating controls, recall the discussion we had on segregation of duties, a delegation of authority, recall that discussion. So they're all operating controls. Identification of risk reporting and mitigation, evaluating controls, monitoring controls. So let's pick up some examples on each of these elements. As far as risk identification is concerned, for any of the functions which are there in an operating, let's say a commercial activity, a purchase activity of an organization, or an invoicing activity of an organization, or revenue recognition. So for those functions, the first part of it is to identify what are all the critical risks which exist, and these risks have to be made as part of the risk register. In fact, don't get me wrong, I've come across many who have signed off on IFC functioning where those organizations don't even have a risk register. So first requirement is you need to have a risk register for all of the functions which are there. So risk register would typically be almost like it'll almost be like a laundry list to begin with, where you list down every possible thing which can go wrong, what all can go wrong. Then you can do a filter and say high, low, medium, all that stuff you can do. But the first act would be to say that these are all the potential mistakes which can happen in a purchase function. These are all the potential mistakes which can happen in an invoicing function, or it can happen with reference to capitalization of assets, whatever it is. So you need to have a risk register for all of that. That's your first step. And without existence of risk register, forming an opinion on the operating controls, existence, functioning and all is just not possible. So that's our first requirement. Now, having said this, I just want to leave one word of caution. I've also come across this situation where many have accepted engagements on designing controls, implementing controls. So let's assume financial year 17-18, you accept an engagement on designing and implementing controls. You need to remember that for 16-17, somebody has already signed off saying it's existing. So when somebody has signed off that it's existing, now a mandate being accepted would be contrary. So how to manage that? I'm sure you got the answer for that. So it can be a GST advisory services, whatever it can be, and you get this activity done. But you cannot have a situation where you have this mandate when somebody has put his head on the block and said last year, with the promise that by next year everything will be right. At least I'll be very honest, my 9 years of practice, that's how I did. Every time entrepreneur said by next year I'll ensure fixed register is updated, I said this year everything is proper. But right through my 9 years it never got updated. But like that. So here also, so when these assignments are accepted, a word of caution, particularly for the statutory auditor, was already signed in the past. So it starts with the risk register. Second is risk reporting and mitigation. On the risk, define the risk reporting protocols and the periodicity. Risk reporting protocols would mean, and periods would mean, there would be some risk which you will have to test it on a monthly basis, some on a quarterly basis, and for whom it has to be reported. So if we discover something, to whom it has to be reported. Something as simple as a BRS. So when it comes to a bank account statement, more often than not, most of us keep it as a monthly item. So monthly item, and in that monthly item, let's assume there are some unexplained credits which are there for more than 3 months. So you should have a policy and procedure to say that if it is more than 3 months, I'll get it reported to the financial control or I'll report it to the CFO. And if it's more than 6 months, I'll report it to CFO plus CEO. So you need to have the periodicity and the reporting structure for all of these risks which are there. So for all the risks which are there, recall we discussed as high, medium, low and all. So depending on high, medium, low, you need to also have the periodicity in which those risks will be tested for and the reporting structure for each of those risks when you discover that there is a control weakness, and suggesting mitigation controls for all the risks which are there. Evaluating internal controls, so ensuring that these key controls are updated on a regular basis and consolidating the level of operating effectiveness of the controls. So obviously when you express an opinion, it's not based on 2-3 controls which might fail. So you need to look at if there are 60 controls in an organization, obviously 5, 6, 7, 8, 10, 12 are likely to fail. So it does not mean that the controls are not functioning effectively. So you need to take a holistic view of the overall controls before you form an opinion on the functioning of the same. So that's the consolidated view which you take. And a continuous monitoring needs to be done in terms of continuing to update your risk register, the existence of adequacy of the controls. The controls which I have designed, are they adequate or not? And assessing in creating the dashboards for continuous monitoring of risk and controls. And those dashboards are extremely important. In fact, if controls have to be functioning effectively, the more qualitative you design the dashboard and keep publishing it, that particular dashboard, if it is inviting attention, which means you have done a good job. More often than not, these reports are largely Word documents of 10 pages, 20 pages, 30 pages. that itself is a risk of failure of the entire internal controls. So equally important is the final report which is done should have a dashboard, which dashboard can be published to the relevant stakeholders depending on what level of aggregation you want to do. So that is also an important part of the operating controls. IT general controls, 4 components for IT general controls. Review of the policies for the IT part of it, IT organization. Understand the physical and logical security applicable for the entire IT landscape of the organization, which includes network as well, not just applications, but also the infrastructure and the network. Review the data retention policy of the organization and keep testing the application controls. So on each of these 4 components, first to begin with IT policies. So every organization to have a policy document on the IT organization. So what is the architecture, what is the chain management policy, all of that need to be defined. Have an understanding of the physical security as well as the logical security for the entire IT access, which includes infrastructure as well as applications. The policy of an organization for data retention and data recovery, the business continuity planning process which an organization has, and how many times they have actually tested the effective functioning of the BCP. And I can share with you, and I've gone through the same experience myself. More often than not, there is a standard assumption that backup is available. The guy has continuously taken the backup. You ask him, did you take a backup last Sunday? Yes, I've taken. Again, next week you ask, have you taken a backup? The answer is yes. And you get used to the answer yes. And when it actually fails, you will not, and you want to try the backup actually does not function. So it's important that every organization should have the discipline of testing whether that backup is actually working. Some of these, don't get me wrong, that I'm sounding very basic. Some of these might appear like, do people actually don't do this kind of BCP procedures? My experience is 99% of them actually don't do it. So if you look at some of the large organizations, or I'm sure some of you have the experience of some of these large IT parks and all, they have a very disciplined approach where every quarter they would go through a fire drill. Every quarter they would go through a fire drill. So for us it looks very odd. They'll make us get down at 3 o'clock, 1.5 hours you have to just stand and chill out there. Sometimes it's hot. You have to just stand for 1.5 hours and then get back into the office. So that's a process. Sometimes it looks very mundane, it looks very odd, that you have to go through this every quarter you need to go through. But when the incident actually happens, that process actually helps. And each time they do a fire drill, it's not that the fire drill process was efficient. You'll still find that despite all the alarms and all the systems, if a building has 10,000 people, 100 people will still stay inside the building and do work, or they'll stay in the restrooms and come out and then do their work so that evening they can go back, or the boss himself will tell that stay back there, finish the work and come. So these are things which are there. But these are common practices which are there, but they are actually setting the tone for that particular organization. So similarly on BCP also, if an organization has a culture of ensuring the DR and a BCP process and testing it regularly, the good thing is that same culture will go to the people below also, to people below. I'll just share you a little experience. I think some of you must be working in multinational companies. I'll give one example. An organization like Shell Shared Services, which is there on OMR or Perigudu, wherever it is, Shell Shared Services. If you look at the particular building, anybody getting into the building, let's say I were to go with a three-wheeler without a helmet or going in the car without a seat belt, can be guaranteed that by the time he goes into his desk, he will have his pink slip and he can leave his job and go. So that's the health practice or a safety practice which has been brought inside the particular organization. Even for staircase getting down, there's a process on how you have to get down the staircase. It's all defined. And it's so much imbibed into the person that even when it comes to his personal life, he follows exactly the same practices and it goes to his family, his children and all that kind of stuff. So that's how those organizations actually have trained the people. So it helps an organization later as also a good policy for the family. Tomorrow let's assume the family something goes wrong. This helmet would have helped him. This safety belt would have helped him. So how has this discipline come through? Because of the organization. That's how you have the bonding with the organization. So these are other side benefits which are available to an organization. So similarly, when it comes to BCP and all, extremely important that they need to be tested. And I have come across instances where you have done this drill of trying to use the recovery part and it has actually not worked. Fortunately, the production server was working and you continued it, but you have learned it. For the next time you are careful that, okay, look, you need to be careful, this is the experience this time. So that's on the data retention and recovery. Test the application controls on a continuous basis, and with extensive use of internet these days, application controls are very, very important, and application control should not just stop at the application level. They need to be also looked at the infrastructure level and the networking level also, given the very wide usage of internet. And on internet, very common thing on applications also, leave aside the controls inside the application. The users of the application, the way the passwords are exchanged, passwords are set, all of us are experienced working in organizations. I have seen people share passwords left, right, center, and when something goes wrong, blaming does not help. But I've seen that in very senior professionals also doing those things. So those cases, tone at the top makes a difference. The moment you know that your password is accessed by your person. In fact, I strongly believe that if I have to approve the travel claims of my people below or whatever, I need to do it myself, or if I'm not able to do, I give up the task and give it to somebody else, but not to give my password to somebody. The moment I give my password to somebody and say that you access the intranet and clear the travel claims, because they're generally considered as routine, you are actually setting the tone at the top. That tone at the top itself is a big control failure, and the whole organization can come to a safe conclusion that IFC will not function effectively. And this is something you'll find very extensively in many organizations. Leave aside MNC, a very large organization, rest of them, the password compromise is extremely high. And global perspective, I'll spend a little bit of time. As far as the global perspective is concerned, I would like you to correlate this in the context of NFRA. NFRA, at least the government keeps saying that we want it like PCOB, we want it like FRC of UK. But those bodies are extended arms of the capital market regulator in those countries. For example, PCOB is part and parcel of SEC. SEC extends administrative oversight on PCOB. So that's how it is. It's not an independent body as the government is miscommunicating to the whole world. So it is part and parcel of capital market regulator. And these bodies, they function only with reference to the listed companies and not otherwise. They don't cover unlisted companies at all. Whereas NFRA, which government keeps comparing with PCOB and FRC, they intend to cover beyond listed companies into all the unlisted companies of a particular size as well. And it is not, NFRA is not an extension of capital market regulator. It's a separate body coming as part of the Companies Act. So the requirements of ICOFR are requirements in US through PCOB, and in UK it is a requirement which comes to the Financial Reporting Council. So they have prescribed the requirements of the reporting requirements, including the key management personnel signing off on the same. So their reporting requirements are essentially two: CEO, CFO certification, and second is the audit report. So two reports are what are required, whereas here we have a whole list of people being made responsible for ICOFR. So IFC in today's context, why it's more significant. IFC is more significant in today's context. As all of you are aware, CARO 2016, prior to that we had multiple versions of CARO right from early 70s. So CARO, MAOCARO, whatever nomenclature it had, it always had a paragraph on existence of internal controls and functioning of the internal controls, whether they were adequate and commensurate to the size of business and all. And if you look at CARO 2016, there is no paragraph or no reporting requirement relating to internal financial controls in CARO 2016. So it's been removed out of CARO, and hence it is now a separate certificate. It's removed out of CARO, and hence it's now a separate certificate or a separate report which is given by the auditor as part of his overall audit report. So that's one material part. And the IFC scope as envisaged now in Companies Act is far wider than the earlier one, because earlier one the focus was largely on internal controls. Now internal controls, we have a broader terminology called internal financial controls and a sub-component called internal controls on financial reporting. So all of that is there. So if somebody was doing internal control reporting in CARO up to 2015, that reporting requirement will not be adequate. The process you follow to satisfy yourself for a CARO reporting will not be adequate for giving a similar opinion now in the context of IFC, which is prescribed here. So here the requirement and expectations are much wider. And here IFC would also enable reporting of fraud, which is the requirement we have in the Companies Act. Some common myths, I'll just spend a few minutes on this. I don't think I need to go through the whole list. But on internal controls, as I started off, many have this, in fact, many managements have come across, sometimes auditors don't be assertive enough to tell them that, look, it is not checkbox item. Internal controls are the safety systems designed to help you to grow faster. I have good safe seat belt, I have a good brake systems, I can drive much faster. Without a seat belt, I can drive at 60. With seat belt, I can drive at 100. I have good braking systems, I can drive at 120. So these are meant essentially for business. So they're actually meant for enabling business to be done much better, much faster, and much more efficient than what you could normally do. So that's the important point. So one should come out of the mindset that it's a reporting requirement, Companies Act wants it to be reported, Companies Act wants it done. People need to understand that because I don't tend to do it voluntarily, the government is making you to do the same. Let me draw a small parallel. There are many senior members here and they will recall, up to 2013, we had this company's transfer of profit to reserves rules. So every time you pay dividend, some profit you are required to transfer to reserve, hold it back. That's a governance issue. The idea was you should not distribute 100% of your profits, hold back some profits, because inflationary economy you require it for expansion and all that stuff. Earlier we also have a situation where you need not provide depreciation if you are not distributing profit. If you are not distributing profit, whether you provide depreciation or don't provide depreciation, profit is remaining within the company and you can use it for managing the growth of the company and things like that. But if you look at the Companies Act 2013, you don't have this transfer of profit to reserves rules. The idea is probably we have matured lot. Maybe up to 2013, the government had to tell you, don't distribute whole profit, hold it back, be careful, hold it back, be careful, and then distribute only portion. But now that there is maturity, that clause has been removed off. The idea is people will apply common sense and say that, look, don't distribute the whole of the profit. So that's the important. So when it comes to IFC, IFC is brought in through the Act basically as a business enabler. If you look at the internal financial control definition, the 5 elements which I started off, if you recall, the very first thing, policies and procedures, was for orderly and efficient conduct of the business. Rest actually come later. So the best way to communicate IFC is to help the organization management to embrace it as a tool which is meant for them to be productive, and to verify whether it's productive or not. As an auditor, I help them on that process. So that's how the entire communication needs to be done. But I've seen many communicate that Companies Act wants it, so please do it. So that's a very wrong approach of the entire subject. You need to help them to understand that it's in their interest. And when it comes to one of the other common myths which I keep coming across is, we have a good ERP system, we have implemented a SAP, we implemented an Oracle, which means controls are there. Implementing an ERP does not mean you have control systems. So when you implement an ERP, the quality of time you spend in terms of understanding your business processes and in that business processes, bringing it as part of your workflow in the ERP is what will help you to have the right kind of controls. And my experience, it is a process of maturing. At least my experience, I can be very honest. I have myself learnt it over a period of time. There are many cases where you find that you think this control is enough, but when you look back 3 years later, you find probably that was not enough. Then you start strengthening the control. So you keep doing that. It's a continuous process and the maturity comes over a period of time. So never one should fall into the trap that I've implemented a SAP or implemented a Oracle or any other JD Edwards or whatever ERP and get the comfort that controls are in existence. They are not an evidence of existence of controls or the functioning of controls. Everything is to do with an understanding of business process and the way you have captured that and enabled the workflow into your ERP is what matters. And when it comes to the IFC, the entire IFC focus is to be seen as beyond compliance. I've spoken about it enough. Come out of the checkbox mindset. It actually helps somebody to do the business much better. I keep equating this example always with the safety devices in an automobile. The higher the quality of safety devices, the faster somebody can drive. It helps improve investor confidence and things like that. And when it comes to the internal controls, one of the good things when you do this control testing on an annual basis, it helps you to look at every year that some of these controls were designed so tight that they are harming the pace of the business. You can actually review and dilute the controls. I have myself gone through experiences where when you initially design the controls, you say that 4 signatures are required. First level somebody signed, second level somebody signed, third level somebody signed, fourth level. And many occasions you find that fourth guy, third guy, second guy have signed because the first guy has signed. So that's a very common thing which you come across. So as you keep reviewing it every year, you discover that out of these 4 controls, maybe one can be eliminated this year. Get little more confidence, then remove the other one. It actually helps better doing of the business. So one way, there are cases where you can actually strengthen the controls. There are also cases where you can actually reduce the number of controls and make the business more efficient. In fact, I go back always. IFC is more about enabling an orderly and efficient conduct of the business. Rest of it are all other goals, but that's the first primary goal. It's actually meant for that. I keep equating with that general reserve. I should do it myself, but government told me. IFC, I should do it myself, but government says, look, you're not yet grown enough. I am telling you, you do it. So that's how this entire IFC functioning is all about. And when it comes to the certifications and all, existence of good controls help the CEO and CFO to sign off. Now, as far as the IFC implementation process, of course, all of us have actually crossed that process, but assuming new organization, assuming a new company is set up, and you're now designing controls. So how do you approach that? And the Institute Guidance Note is a Bible. It's an exceedingly good document, and I'm not sure how many of you are aware. There's a supplementary document to the Guidance Note which is called Internal Financial Controls for Small and Less Complex Companies. It's called, that's a very good document which is meant for smaller entities. And on IFC, I also let me narrate one personal interaction with MCA. When there's one interaction with MCA secretary and joint secretary, and the representation was, let us exempt or increase the threshold. Increase the threshold. We call that 50 crore and all that stuff. Increase the threshold and make it applicable only for much larger companies, say 500 crores, 1000 crores and all. The response was, as an auditor, any case when you perform the work, you have to apply SA 315. When you apply SA 315, you are in any case required to check whether there are controls in the organization, whether they are functioning effectively. So his response was, are you telling me auditors are today signing? Are you telling me that auditors are today signing without testing all of these controls? What we are helping, his response is, we are actually empowering the auditors to say that, look, what was considered as one lost element in the responsibility which you had, we are highlighting that and helping you to tell the management and companies that, look, this is a very important obligation all of you are carrying and I am required to comment on it, so be careful. So their response was they are empowering the auditors by having this IFC as part of the entire reporting obligation. This is again a conversation which I had early 2016 where the secretary and joint secretary, in fact, despite the fact that they're bureaucrats and come into the corporate affairs ministry for short time, they still have this kind of awareness, and trust me, he quoted SA 315. He went to the extent of telling the number SA 315 at it and said that, look, you have this standard and you're telling me that this standard you have not complying with it. And he only gave, and I should also compliment, he only gave the idea of you come out with a document on how to handle small and lesser complex entities, because if you look at many of the smaller companies, 100 crore companies, 200 crore companies, those companies, they're all proprietary driven organizations. And my experience, and I'm sure experience is with all of you, proprietary driven organizations, controls are the best. You may not have documented IT controls, documented financial controls, but where it's a proprietary driven company, whether it's a 200 crore turnover or a 500 crore turnover, that entrepreneur has a complete understanding of everything happening in the organization. These are actually required only for companies where there are professionals where each guy thinks it's the other person's responsibility. Whereas when it comes to an entrepreneur-driven principal shareholder, it's his entity. So the way he owns up, he knows everything happening in the organization. Every check he actually signs, every negotiation he actually completes, every invoice and collection he has a complete understanding. Every asset he purchases, he knows what he is purchasing, he knows where it's existing. If he does a factory visit, he will ensure that he is visited and ensure all the assets. As a professional, if I go, just go there, enjoy the hospitality, I've flown enough, I got the coffee tea. I don't take the pain of walking inside the factory, verifying the condition of the machines, etc. I'm sure this behavioral difference, all of us have definitely seen it. Of course, I'm pro and not an entrepreneur, but still, I can very honest, as a professional, just go there, just walk around and say, oh, it's there, okay, come have your coffee, tea, sandwich, and then come back. Whereas an entrepreneur, the way he walks inside the factory, it's his machine, it's his money, he has used it. Where is that machine? This machine we bought 7 years back, how is it functioning? This spare part was replaced with, so those kind, where is that removed spare part, where have you kept it? So those kind of questions and all. That itself is a big control, where it's not documented, but they exist. So in that guidance note for small and lesser complex companies, it recognizes that there may not be documented controls, but still you can satisfy yourself about existence of controls and give an unmodified opinion. So that's the other guidance note which exists. So it talks about defining policies and guidelines. You need to define and enforce the same, and have standard operating procedures which are all well harmonized, and you don't have conflict between operating procedures for different activities. Define roles and responsibilities of all the people who are concerned. Have prevention controls, automate the controls to extent possible, and importantly ensure that it's a continuous management information system and it's adequate enough for throwing up the controls. And as far as the framework for IFC is concerned, the international frameworks, in India we don't have the framework. I don't know how many of you are aware. At the institute, when the guidance note was originally prepared, it was prepared based on the COSO framework, but COSO is a intellectual property, it's a copyrighted one. So we had to withdraw the guidance note and then prepared a fresh guidance note, which is almost the same as that, but we have not copied those terminologies. We have tried to convert active voice to passive voice, all that stuff here. That's okay, doesn't matter, that's okay. You have to do like that, what you can do. So, but in any case, it's a good guidance note which is there, but that's a history. We need to know that it was initially drafted based on that, and now it is revised, and we have our own guidance note on the same. And so these are components which we have discussed. So implementation of IFC, I did start with this discussion. So you have these 3 lines, first at a management level, directors level, and then at the auditors level. So you have the 3 lines of defense, as they're very popularly called as 3 lines of defense as far as control systems, existence is concerned. And methodology, I'll spend a few minutes on this and the next slide. Methodology of implementing internal financial control. I'll focus on the next slide actually. This is a good slide, and since I'm leaving it black. So this slide talks about the entire process which you go through in terms of designing and ensuring that there's a good internal control system. So it starts with having a plan and scope. So what is the total scope of the entire organization? What are the divisions? What are the functions? All of that you do and have a plan for it. Perform a risk assessment. Recall we discussed about the risk register of each of those stuff. So finish that activity. Identify all the significant controls for mitigation of all the risks which have been identified in the risk register. Document the controls. Evaluate the control design, so the way it has been designed, or whether it can function effectively. Evaluate the operating effectiveness of those controls. So once you have controls, also test whether it will function effectively, to test the same. Document the results and take steps for remediating the shortcomings which you have come across. Any shortcomings you come across during the testing process, remediate all of those kind of control weaknesses, and then build sustainability into the entire controls which you have designed so that they are sustainable for a long run, and they should be such that they should be able to sustain the audits which are done. So this is a fairly good snapshot of the process in which you have to implement the entire internal financial controls within the organization. And in the guidance, this is not from the guidance note, but in the guidance note there are a few good flowcharts available function-wise on how the IFC needs to be implemented. This is one other important illustrative slide before I come to the audit reporting process, and then I'll conclude. This is an illustration of how the entire activity happens. So for each of the activities, you identify the risk universe, that risk register which I told, and out of the risk universe register, how many of them are fraud related. So make a list of, for each activity, let's say here you have planning and budgeting, you have vendor management. So each activity, you identify how many risks are possible. Out of those risks, how many of them have a possibility of becoming a fraud. Then for each of them, you design controls, and these controls, some of them can be IT enabled, some of them can be manual. So if you take this illustration, planning and budgeting, you have some 12 risks which have been identified. Out of the 12 risks, you have controls which you have designed. It's not necessary that for all 12 risks I need to define a 1:1 ratio of control. It's not required. Some could be merged. Some I may decide not to have a control at all. So I have decided to have about 10 controls. Out of 10, 7 are manual, 3 are automated. So each of them you go through this process. So this is only an illustration, and each organization will have a different risk universe and a control environment. And when you test the controls, so if you take the same example, planning and budgeting activity, 10 controls are what I have designed. Out of these 10 controls which I have designed, I found one manual control was ineffective, one automated control was ineffective. So effectively, 2 out of 10 have failed. So which means 80% level, 80% of the controls are functioning. So each of them you need to do it objectively. So idea is ultimately when you form your opinion, you'll have something very objective for you to form an opinion, and these evidences make a lot of difference. And let me just step back a minute. I don't know how many of you are aware. I see a good number of here who are in the activity of internal audits. Internal audits, as you know now under the Act, internal auditors are required to file saying that they have accepted the responsibility. At the institute, we have one of the non-standing committees is Internal Audit Standards Board. And Internal Audit Standards Board has decided to issue about 25 standards for internal audit. Out of 25, 5 of them exposure draft is already issued. Comments have also come, and hopefully in the ensuing council meeting, August 6, 7, 8. So those 5, subject to comments and council discussion, 5 standards will get approved. The process is set. Maybe by end of this council year, we might finish 15 standards or so, and these standards initially will be recommendatory in nature, and subsequently they will be made mandatory. So the idea of having this audit standards is tomorrow they should serve as a insurance mechanism for the auditors. Audit standards are your best insurance plan. So tomorrow if you prove that work has been done as per the audit standards, there is no way anyone can touch, even if the company has gone bad. I'll give a very recent example of, I can't name the committee or the name of the entity, but it's a very important committee where majority are government nominees. And this is a case where it's a high profile case, and this particular case, after all the reviews were done, almost a 200-page report was there on the audit quality, auditor's work, and that's a company which has gone bust and all that kind of stuff. And the government nominees were hell-bent to say that, look, company has become bad, shareholders have lost money, bankers lost money, etc. Auditors have to be hanged. So that is their argument, and they are in majority. They are in majority. And when you represent, they think that we are having a soft attitude towards our auditors. We are trying to protect. Somehow they continue to have that perception. But the fact was, the auditor performed all the work only as per audit standards, and for all the work which he had done, there were enough audit working papers which are available. So not a single observation was there where he could not support the same, For example, sending confirmation of balances to the parties. The other party has not confirmed. What can I do? I have done it and I have also followed it up. So I have done it. So based on this, I'm just giving a very loose example, but a little complex one. I don't want to give more hint because you will be able to correlate easily. So there was some valuation related accounting, all of that stuff was also there. So the thinking was, somehow we have to fix this auditor. Somehow we have to fix, because it's a large audit firm, and if you fix it, it will be like government has achieved by hanging one auditor. That's one achievement. But the truth is, what came to the protection of the auditor was exceedingly good documentation that work was done only as per the audit standards, and this is sometime in the year 12-13. We are now in 18-19 when the discussion took place, and this is a work which happened in 12-13 which has come to the protection of that auditor. Like this, there are plenty of instances. Audit standards compliance is the best insurance somebody can get. As long as you can demonstrate that you have done work as per audit standards, you are safe. So these internal audit standards are in the process of getting issued. I have the small request. On the 5 internal audit standards, we have got close to about 120 comments, but they have come only from Western region. From here we couldn't get anything. My request is for the subsequent exposure drafts when they are issued. There's plenty of experience I'm seeing here. All of you have lots of experience. And these audit standards we have drafted very innovatively. Every standard will have only 5 sections. Every standard will look and feel will be same. So only 5 headers. Under 5 headers, you have some paragraphs. Each standard will have average 4 pages. So if you have simple document, easy for people to follow. So from that perspective, they're all getting drafted. For the future exposure drafts, request you to participate in those exposure drafts and share your comments so that we can develop robust, to borrow that word, we can develop robust audit standards. So please share your thoughts when the future exposure drafts come. So coming back here, so when you come to your conclusion on the opinion about the audit of the controls and all, so an objective evaluation, and that working paper is an important working paper which you need to have. Now, audit report, it's part of the election. I'll just take you to the following. So following situations of a modified opinion, a qualified one, an adverse or a disclaimer. A qualified opinion for the existence of controls, operation, and the effectiveness of controls. One, where there are effects which are material but they are not pervasive. So out of various functions of an organization, one of the functions, something is material and you can take steps, but it's not something impacting the whole organization. Those cases, you just give a qualified opinion. And my view, people need not hesitate about a qualified opinion. I keep coming because many auditees who feel qualified opinion, I don't know how can you qualify me and things like that, how can I have a qualified opinion? There's nothing wrong about a qualified opinion. You need to be concerned if it is a adverse one or a disclaimer, which are extreme situations. As organizations are built and they grow, it's quite possible. For example, I've spoken for the last 1.5 hours, whatever. It's not that everything which I've spoken is error-free. I'm sure there are some areas where probably I've slipped or things. I'm sure they must be there. So it's quite common for everyone. So for an organization also, as it is growing, there would be some areas where controls maybe are not functioning effectively, but it is not pervasive and impacting the whole organization. So those cases have a qualified opinion, nothing wrong about it. An adverse opinion where it is material and it is pervasive, impacting the whole of the organization. So revenue recognition is wrong, consequently profit is wrong, receivables is wrong. So it is a fairly pervasive item. So those cases you give an adverse opinion. And where you are unable to get any information, not able to satisfy yourself, those cases you disclaim your opinion. So similar principles as what are applicable to an audit opinion are what is there for an opinion on the internal reports as well. So these are examples which I have given for each of them, and with this probably I'll conclude and I'll leave the floor open for discussion. And I see a lot of senior members. I request you to share your experiences too on this subject. I don't think I can speak beyond what I've spoken, but happy to interact and also listen to your experiences. I request senior members in particular to share their thoughts because I see a lot of younger chartered accountants and they should get the benefit of your exposure. So thank you all for your patient listening.
In the first slide, you have touched actually about you referred the earthquake. No, it's okay. So,
No, it should reach audible to the people at the last.
So in the earlier Caro days where you were talking about that, it is at the time of reporting the controls were working fine. For example, in a simple case like the vendors balances, as long as it is in credit, people are happy. But when you see the bill-to-bill thing, when I want to check the correctness of the creditor balance, it is not. Why? Because for each bill, at least 12 lakhs has been paid in excess. Why? Because the PO was in INR, the payment has been made in US dollars. Because of the exchange fluctuations, they have lost 12 lakhs. But that impact comes from the earlier years. So what is the responsibility of the auditors, especially internal auditors? Because I'm mostly into internal audit. So in reporting, of course we have reported, but in terms of IFC, what is our responsibility in, because our scope starts from this year actually. But the impact...
You are telling there was error in the past and
which
you
has
have
a cascading
discovered.
effect of,
Yeah.
yeah. So what is our responsibility to go back to that earlier years and report?
No. The question of going back to earlier year doesn't arise. When you are testing for this year, you have discovered that there is this accounting error which has crept in the past.
It's not an accident. Actually, money has also gone out.
Yeah, it's an error. No, it's an error where you have not done that matching. Ideally, that exchange loss should have got captured as a exchange loss and recorded in the financial statements.
No, it is not an exchange loss also. They are not supposed to pay it in the dollar. But they have paid, the PO is for INR.
PO is for INR, they have paid it in dollars.
Dollars, which is not actually, they say it is for supporting the vendor.
Okay.
It is not a question of...
No, my view, as long as there is a management justification as to why they want to pay it in dollars, I don't see it as a issue. But those cases cannot be there because when you pay it in dollars, you have to get the audit certificate. There's a lot of process involved. I don't know how it happens. I don't know if anyone else can throw light. What he's saying is the PO is in rupees, but the payment has happened in dollars. Without the payment term being...
management, saying that the chairman has approved. So when we went to the chairman, he said, I am signing all the papers. I don't know what the specific cases, I didn't get the specific approval. And no one has get the specific approval saying that I need to pay in,
So it's basically a control weakness there. It's control weakness which you need to highlight. Yeah.
In his case, at least the PO should have been amended.
amended, and I think the auditor would not have certified that you can make this remittance without a clause that it's payable in dollar and things like that. So there must be something. I think he is referring to a smaller organization which is more promoter driven.
Yeah, mostly.
Promoter has some overseas entity somewhere. I said, okay, pay it off in dollar. If it has happened, I can't see. But otherwise, normally any remittance in dollars, so unless your PO has the payment term in dollar, the auditor would not authorize whoever is the chartered account signing the remittance, would not have allowed the same. So if that has also failed, then you bring that control failure to the audit committee and the board.
And another thing you are talking about is that one case actually, I mean, in internal control over financial reporting, it has been mentioned reasonable assurance, reasonable correctness. But IFC says that complete, and the accounting records are complete and correct. So correct is not possible in accounting because we can, when the auditor itself is saying it's a fair view of state of affairs. How a accounting record can be correct? It can be only fair.
No, fair, one is accounting record, other is the financial reporting. See, accounting record can only be correct. As far as the financial reporting is concerned, there are estimates and judgments. So that reasonable assurance is in the context of financial reporting, not in the context of record. So when it records purchase is 1,000, I should write 1,000. Sales is 10,000, I write 10,000. I cannot have a different number. But when I do the financial reporting, I have the estimate of provision to be made for receivables and things. So that's where that reasonable assurance on the reporting comes. So the reasonable assurance is in the context of the reporting. So they don't use that expression for the other parts.
For example, if the same company if I am taking,
Yeah.
there is a huge mismatch of physical stock and the book stock, which has been completely booked in production, completely charged to production, that when you go to the SAP logs, we see that all the entries has been posted on a Sunday. So, in this case, what is the internal auditor's responsibility, how they will go about to the, of course we have...
Our responsibility is to report, that's very simple. So that's,
more to manage.
no, I think one thing, come out of the mindset that I have to help them to be clean. And my job is not to help them to be clean. If they have passed entries on a Sunday and there are errors, I report that there are errors and they happened on a Sunday, consequential risk is high and all that kind of stuff. That's all I report it, that's all. Unless someone else has a different view.
No, it's all as happened.
No, I agree.
But is
No,
there anything
just
else?
report it, man. Just report it, man. Reporting is a good thing to do. No, I'm very serious actually. I'm very serious actually. In fact, right from a young days, mistake happens, go and tell your boss first. Over. Which means the problem now becomes boss problem. No, I'm very serious actually. I'm very serious. You have to just go tell. By holding it back, you are taking that for your lifetime. You know, why should I take it? It's happened, it's happened. So,
In case of
The assistants were not allowed
Pardon?
inside the factory
It's a
gate.
modified report. Do we have to specify the circumstances also?
no, not required. But you need to have it as part of your audit working papers. No, but if you're telling that modified report, you are saying that it is qualified. If it's in the context of, let's say, a particular judgment, so you need to bring that, draw reference to the judgment. You need to give.
Sir, I would request you to have a case study and a workshop specifically on IFC.
Okay.
We need to be trained at a micro level.
Okay.
Because
No, I tried to do those 2-3 slides I've done. I've done those 2-3 slides. Beyond that, okay. I'll see if I can. I don't know if I can do it in the next 1 month, but I'll see if I can get another faculty to do the same. Only on case study. But I want to tell you that last few slides are actually an illustration of how the controls are. And it's actually that risk register, the number of controls for each risk. If I have 12 risks, I need not have 12 controls. Okay, if your question is, what are those possible 12, what are the possible 10, we can do. Krishnamurthy, you can do huh? You can do something. Here's one case study. He's actually from ex-Wipro and he spent his whole life in ex-TCS and Wipro, I think. So I spent his whole life on that. If it's okay with all of you, we'll ask him to do a 15-minute case study.
No, but not.
Not today, sir. Okay. Okay, no problem, no problem. Yeah, sure. He's been in TCS actually, doing the same thing for 25 years without getting bored.
And again, in the risk register, what is the responsibility of auditor to see whether there is a risk register? Because
Yeah,
management is only the management.
Everything is management.
Management responsibility.
Our job is the easiest job, we report, that's all. But let's say you take a consulting assignment to help a company to draft, then you take that responsibility.
So
But
consulting assignment means I should not audit it.
obviously,
after
then
1
you
year.
have a conflict, no?
I mean, after what is the time lapse? 1 year or 2 years?
I often don't have an answer on that. I often don't have an answer on that. I need to check the code of ethics of the institute. My experience, my wish should be at least a 3-year gap.
3 years.
That's my wish, but I don't know whether it's a technical answer from the code of ethics. You need to study. And code of ethics I want to share with you. There's an excellent publication of the institute on 1st of July. FAQ on code of ethics. It's available, soft copy is available on the website. And publication should come anytime now, but it's a good document. And code of ethics, the number of violations are pretty high, so it's good to refresh once on the code of ethics. Code of ethics, very common thing. Many people still continue to have success fee, share fees with non-chartered accountants. They're all very common mistakes which people do. And my first level conversation, at least I get a sense that they've done it innocently without being aware. Of course, whether we can pardon them is a different issue, but that's the impression you get. It's good that people should go through that FAQ. It's a good document. It's a very simple document. It won't take more than 5-6 hours of reading.
So the risk management.
Only 5-6 hours, right? Hey, come on.
Yeah. On the,
No, to prepare that we have spent almost like 2-3 months. 5-6 hours studying for it.
on the risk management framework under section 1774 or the clause 49 listing agreement, is there any requirement to have a risk response from the management, like
Yeah,
risk
yeah.
acceptance?
Yes. You
So
should
that
have.
we will know that whether to avoid.
Yes.
Accept or,
So when you form your opinion, that's an important thing.
will
So,
that be documented as part of the
Yes,
risk
yes,
register?
no. One is part of, see, recall I told you, there are 12 risks,
Yeah.
whereas I designed control only for 10.
Correct.
I decided 2 risks I'll accept. I'm okay with living with 2 risks. So when you prepare that thing, the fact that you accepted 2 risks is part of the document. So it has to be there.
So that 4 elements need not be part of the risk register.
The remaining 2, no. I'll capture all the 12.
Yeah.
I've decided that for 2 I will not have any controls. I am okay to live with those risks. So I'll design controls only for the remaining 10. And for those 10, some manual, some automatic. So I can live with risk. So ultimately business is taking risk.
Fair enough.
So
Management is-
you decide to live with certain risk, there's nothing wrong about it. So if management is decided to live with some risk, they will live with that risk. There's nothing wrong about it. It's a good question actually. But I thought I highlighted that.
Yeah,
So,
it was highlighted.
highlighted, but,
There are 4 responses which can be categorized.
Yes.
That's not required.
Yes. So the fact that there are no controls for that, when you assess it, you will see that okay, these 2 risks, the probability of
Because residual.
preventing will not be there. So I need to increase my audit procedures to detect the same. I will take more responsibility. If there are controls designed for preventing and detecting, then my work will be little more softer. If there are no such controls, then I have to increase my
I thought
procedure.
it's usually the other way around because we are testing the controls. Those 2 risks already the management has accepted to.
No, but those risks, they have decided to live with it.
Yeah, so
But they can affect your overall financial reporting, or they can affect, no? So just because they accepted does not mean I can have an error in the financial
it's
statement.
more from ICFR.
Exactly. It's a good question. No, some of you can share your experiences too, and have the benefit of others.
Sir, all together what we discussed, actually the current, just I'm sharing my 15 years of experience in banking and the financial industry I'm into. The challenges here is, even though we move to a dynamic environment, but the people are more of process oriented here. To make them understand what is the risk control, that design and OIT still actually the miles to go. It's my understanding.
No, all of us agree with that.
This is the major challenges. I know so long, still we are facing the same challenges now also. Because what is the best fit, you want to share how to really educate them to, come to a
No,
stand?
my view, my experience is tone at the top. I gave you that example of Shell which I gave you, very generic example. I felt nothing like tone at the top. If the tone at the top is towards good risk management and controls functioning effectively, then everything falls in place. If tone at the top is diluted, then it affects the whole organization.
But this training and other things we really develop, it is a kind of routine they do. Actually, okay, they'll just go for a training, they'll go and come back. Again, it is the same static mode.
No, but the question is, when a risk is tomorrow, let's say the control failure, also, what actions you take on that? So if some person has failed on a job which he has to do, are you taking action or not taking action? If you have taken action, then it is going to increase the seriousness of the training. If you don't take action, it will not increase the seriousness of the training. So it all depends on the tone at the top. My experience, at least in running businesses, is tone at the top. So how strong a view you have towards these things make a difference. I don't know if others have a different view, but at least I have good clarity on that.
Greetings, sir.
Yeah, I had.
Good evening to respected members. Sir, regarding this internal auditors, so I want to understand many questions on that. I'll take one on one. Is internal control a replacement of, is internal financial control a replacement of internal control?
Okay, in a sense, yes, yeah.
Yes. Then internal auditors appointed as per section 134 of the Companies Act has to comply internal financial control.
Yeah, whatever work procedures they do, have to take care of that, yeah.
Then is there any certification by virtue of 134 we should give for the internal finance control compliance?
There is no certification to be given by the internal auditors of that.
And
Don't tell it loudly, they'll draft something for that.
No, my indirect question is because internal audit is done as per the requirement of the management. So management will only take on items which they need. They will not go on all the
No, let's not
checklist.
no, okay. I've been a part of management, junior, senior and all. As far as management is concerned, don't come to the view that managements take only some and things like that. They have a better understanding of the business, what the key risks and all, and let's understand management science. So their neck is on the block before the internal auditor comes. Directors take responsibility. It's a very serious one. So consequently, when managements tell, focus on the 6 areas for this year, next area, 4 out of the 6 plus 3 more. So they have applied their judgment. But if you look at standards of internal audit, you have that planning standard. We already have existing standards. So if you look at the standards in auditing planning, you are required to discuss with the management and then agree on what are the areas to be covered for this particular year. And typically management tends to have a say on the areas to be covered. But you can always say that in my experience, I would prefer that this area should also be covered. And if you have documented it, it's highly unlikely management will overrule the same. It's unlikely to happen.
Okay. So
No, say, I'm talking about good large organizations. I'm not talking about 100 crore company, 200 crore company, because they have their own challenges. And those challenges, we have this beautiful document called Guidance Note for Small and Less Complex Companies. And my view, in those organizations, they are largely entrepreneurial driven and controls are very good. They may not be documented. There may be no risk register, there may not be defined controls and all, but they're still very good because everything happening there, the principal shareholder knows. So those companies are different. So when you take large organizations, managements do spend time. So you need to educate them also if they're not aware.
and the CFO and CEO certification. So is this only applicable? It is applicable
Listed companies.
only for listed companies. So is this reporting done to whom? Like to the stakeholders or any
Stakeholders.
entity,
Stakeholders.
NSFE or like that?
No, to stakeholders. It's part of the annual report.
Oh, it's part of the.
Annual report.
Not related to IFC.
Yeah.
Whether a private limited company can be an internal auditor?
Yes, yes, 100%. 100%.
There is no prohibition.
No prohibition. And it can be a non-CA also, it can be an internal auditor. Non-CA can be an internal auditor.
So I have a situation like I've been appointed as an auditor this year, and I need to give an ICOFR report. But apparently I understand that the company doesn't have an RCM, but the previous auditor has given a clean report. I'm not sure whether you can give the answer in this.
No, I can give the answer. There's nothing wrong. All are very. Everybody knows these situations. Everybody here knows these situations, and I myself told you that situation. See, typically those cases, when you accept the engagement, you go through your client acceptance procedure. When you're supposed to go through. Okay, let me go. So client acceptance procedure, and I don't know how many of you are aware. From the institute, there's a format of know your client before you accept any assignment, whatever type of assignment. So one-page document, and let me share with you tomorrow in the case of any action from institute, the first document they'll ask is, do you have a know your client thing and things like that. It's a one-page document, but large firms, typically that document will be a 100-page document. So with one page, simple format is there. I'm sure you would like to collect more information before you accept. So coming to your specific question, it's all how you handle the transition. If I were in a position, would I accept the assignment? I would accept the assignment. I would only ensure that between the auditor and management, I'm assuming these are small unlisted companies, I'm assuming. So those cases, I would ensure that between the auditor and the previous man, tell them that, look, I'm not very comfortable. Please help me in ensuring everything is in place before I can get into the engagement now and I can sign off. So those kind of conversations, these are off the record conversations. But these are all very practical situations. They do happen on the ground. And if they're small companies, I'm again repeating, absence of risk register does not mean IFC is not there. Absence of defined controls does not mean IFC is not there. Absence of IT controls does not mean IFC is not there. So when you perform the work, you have to be conscious of that. So if you look at this ICOFR and all that stuff, it was actually thought through for large professionally run companies. And we are trying to use it for tiny companies. That's where the problem is.
Is it okay to say, for example,
yes, sir.
that we have internal financial controls for a small proprietary concern? They're all there, they're all existing as you say, but they're not documented really.
Yeah.
Is it okay?
It's okay, sir.
You can say it's not
Yes,
documented.
It's okay. And the guidance note itself says you have to do your inquiry procedures and all. You document what is happening. Client has not documented. You document. You tell how you have been satisfied, and then give a unmodified report. The guidance note allows you to do that. It allows you to do that. Yes.
For the question asked,
Yeah.
is it also good for us to go and check with the previous auditor to understand why he gave a clean report like
Yeah, that's what I mentioned. No? Have a conversation, check out what basis he had given, and if there are some areas of concern, request them to address it before you formally come on board.
But what if it's a listed company?
Well, there are listed companies that people are signing for 10,000 rupees. What do I tell about that? So nobody else, but say for a week, it depends. Each case is different. Each case is different.
So is it okay to give a disclaimer then?
You can give, only thing previous auditor will run into a problem, but but my point is, why should you own responsibility for him?
That's what I'm saying.
Go ahead and give it. Best thing, if I was in a position, I'll avoid that assignment. I would prefer to avoid it.
We are waiting for the client to prepare the risk register and all those controls, but till the date of saying that was not done.
Yeah, those cases we have to obviously give.
No, but one thing here is, isn't IFC testing more of a point-in-time assessment?
No.
Not with the,
It's,
yeah, through the
through-
year, of course.
yeah.
Through the year.
Yeah.
If in the current year, if we have a RCM in place and the controls are working, functioning effectively,
I'm fine.
so then we can. Go
Yes,
ahead.
that's what I told him. So he need not bother about whether it existed last year.
That's what it
If at the time of his opinion, if he is able to ensure that
Exactly.
they are in place, he's
So there's
fine.
no point to it.
That was my first response to him.
No, but at particular point of time, will it benefit the entity? For example, a simple example, purchase requisition value should, purchase order value should not exceed 30% of the purchase requisition, because purchase requisition gets tied up with the company's budget. So, but when we test, do the SAP testing, it doesn't allow for 30% exceeding to issue purchase orders. But as you have also given one example, take a dump. The same exercise when we did all the purchase orders and all the purchase requisition, there are n number of cases where the POs were exceeding more than 30%. So then when we look into the root cause, what has happened is that control was lifted in the SAP. There are 130 times it happened in substantially big company. So 130 times. So whether it is okay for the auditor to check only the internal control existed at that time, or should they take a dump for a particular period and say it is existing over a period of time?
Over a period of time. That's what my response to him was. Check throughout the year. Check throughout the year. For example, even in the cost of the Nostro which I told, receipts have come, payments have come, everything gone. Closing balance is only open items. But the receipts and payments, if people check with commission and process followed, then everything would have got detected. So the control systems require you to test the existence throughout the year.
So that means the global transaction, it won't happen in sample cases. I mean, this will not.
No, it's due to a sample only. You also have trigger protection, I can't do 100%. Sample, but my view with all the IT and all,
IT
will almost go to 100%. Yeah. Friends, if there is nothing further, with your permission, we'll conclude. Thank you all for the patient listening, and I enjoyed being here, including the interaction, and look forward to being in touch with all of you. Thank you all.